Hey, what's going on, everyone? It's Sean Mitchell, Denver real estate agent with Co-Listings, and I'm coming at you with another video. And I've got a guest here, one of my good friends and business partners, Sean Boehmer from AmeriFirst Financial. Sean, welcome to my little video world.
Thank you, Sean.
Yeah, I'm excited about talking about some lender-specific things. So these would be things that you would want to think about when you start the process of the home buying search. And we're going to cover a few topics that I think will be super valuable to those that are watching. And if you have any questions at any point while you're watching this video, feel free and put them in the comments down below. So first thing, before we jump in, I just want to kind of say to everyone here that I do a lot of business with you, and one of the things that I really appreciate about you, Sean, is that I call you my Johnny on the spot guy. In fact, just earlier this morning, we needed to update a lender letter for one of my buyers who's in the process of going under contract. And I asked for a small update, and then literally like 30 seconds later, you had that update in my email inbox. So thank you for being that guy.
Well, thank you for the opportunities.
Absolutely. Okay, so the first topic that we're going to cover is when to refinance. So you own a home, right? And you're looking at maybe getting a different, hopefully better interest rate. When is a good time to do that?
Well, there's a number of reasons people do refinance. The most obvious reason is to lower your interest rate, lower your payment. But many people do lots of refinances for lowering your term, getting cash out to pay off debt, or even do home improvements. A big one lately has been lowering your term. And with all of those options, you really want to make sure that the cost outweighs the benefit. Many companies right now are pushing 15-year and even 10-year terms. But what you really want to make sure is that the interest rate in that situation is substantially better. Otherwise, you're probably better off avoiding the refinance fees and just paying extra at a 15-year amortization or 10-year amortization schedule. As far as lowering your interest rate and your payments, kind of the same thing. You want to look at the cost and look at what the return on investment will be. I've always kind of gone off of a 3 to 4 year payback rule. In this market with rising interest rates, it might make sense to maybe bump that up to a 5 or 6 year period, depending on how long you'll be in the home. If you know you won't be in the home for 5 years and you don't get your return on investment, in other words, if you save enough money monthly to make up for those refinance costs in a shorter period of time than you think about moving or maybe selling the property or refinancing into a different product, you might want to make sure that return on investment is probably less than 6 years.
So I hear a couple of things. Let me just kind of interject here. So time frame that you're going to be in the home once refinancing, interest rate is another. So for someone who's watching this, how do they determine whether those things are, what factors to determine if that's going to be a good idea to refinance or not? Well, because each person's different, right? Each person has a different scenario. So
correct, and it just totally depends on your goal. If it's literally just saving money monthly, you take the cost of the loan, you divide the number savings monthly, and that gives you a return on investment on 36 months, 48 months, whatever that number is. And you just make sure that that's going to give you enough time to get your money's worth out of spending the money to do the refinance in the first place.
What types of refinancing purposes do you see most common? Is it I want to lower my monthly payment, or do you see some other scenarios that are more common?
Right now, cash out for paying off debt is a big one because interest rates have risen. If you've had a loan in the last 2 or 3 years, chances are you have quite a bit better interest rate than what's available in the market right now. Another big one that I didn't mention earlier was removal of mortgage insurance. Mm-hmm. That can happen automatically. In some cases, that takes a while. A lot of people, they refinance when they have the equity because you can use an appraisal. So that's a big one right now.
I really love the removal of the mortgage insurance, because that comes up relatively often if you're a first-time home buyer. Maybe you don't have as much money to put down on a home, so you're paying maybe a little bit more, I would guess, on the front end. But after how many years can you typically do that if it's not an automatic thing? So like a 3-year type deal that you have to wait in order to kind of refinance and remove the mortgage insurance?
I would say 3 years is pretty solid in most areas. A lot
Can
of
you
times
do it
even
sooner?
less. Yeah, absolutely.
Okay.
I mean, you can do it as soon as 6 months to a year later if you have the equity, and an appraisal will support that value to absorb the new closing costs and still stay at 80% or less.
Okay. Okay. So that's the key, is the 80%?
Correct.
Okay. Got it. What else?
Um, like I said, cash out for home improvements. That's a big one. I'm a big believer in using your equity to improve your property, but again, you want to make sure that you're improving areas of your home, if it's for investment purposes anyway, where you get the bang for your buck. That would be more your area, but the kitchen, the bathrooms, things like that. A lot of times spending money in the backyard might be nice for you to enjoy the property, but it's not necessarily the best investment. So you just want to make sure you talk to someone if you're doing improvements on your home for investment purposes and growing the value, to make sure you're getting the most bang for your buck. Paying off debt, generally long-term is not usually the best solution, but sometimes cash is king, or cash flow just outweighs the need for long-term savings. So I see lots of people paying off high credit card debt, and it just simply gives them more breathing room. So you kind of got to weigh that too with, okay, I'm getting a little bit of cash flow in my pocket each month, but long term I'm probably hurting myself a little bit. Unless you're paying just the bare minimum on those credit cards, sometimes those can even out too. But a good loan officer will go over all that with you and make sure that you're making the best decision for you and your family.
All right, so topic number 2 is around interest rates, and more specifically, rising interest rates. So what do people need to determine or think about in regards to interest rates, and how that could help or hurt their purchasing power or process of buying a house?
Sure. Well, it depends when you were in the market. If you were in the market a year ago, and then now you're starting to look again, well, you've probably noticed your purchasing power has gone substantially down. If you're just getting into the market, you're gonna come in with the expectation of what interest rates are right now. I would never consider interest rates to be a barrier to purchase a home.
Okay.
To me, especially in Denver, homes have always long-term been worth more now than what you paid for them. I'm not talking a year, 2 down the road. You can obviously run into a little bit of a slump where if you bought a house a year ago, it could be worth less. But if you look at 10 years plus, I've never seen a case where someone's house is not worth more than it was when they paid for it. Plus, the tax write-offs that you get for it. So I would never let interest rates be a barrier to entry to buying a home, unless you just simply can't afford the payment. Long term.
I'm curious to know, because I don't follow this as closely as you do, how quickly are these interest rates sort of going up and down? And I mean, over the last, let's say, couple of years, they probably have gone up a little bit, but do they change often?
Well, it's really based on the bond market. Sometimes you can see a crash in the stock market and pretty much predict that rates might have a good day that day. But the way interest rates work, it's not like it's 4.25 today and it's 4.5 the next day. It can certainly be that volatile.
Yeah.
But it's very complex how the bond market works and how the coupons work, so we won't get into that. But minutely, they go up and down every single day. The more volatility you see, especially in rising rates, is when you see payroll, ADP payroll reports going up. Lots of indicators, jobless claims, things like that. Good things in the economy tend to raise rates. Bad things in the economy tend to lower rates. So that's, the economy has actually been humming along pretty well for the last year and a half or so. So now that's why you're seeing interest rates rise. And
I mean, as sort of that's sort of like the micro focus on the interest rates. Mm-hmm. For most people watching this video, looking at, more importantly, kind of macro level, sort of high level, that's not really going to impact them on a day-to-day basis. But what I kind of hear you saying is that whatever the interest rate is, it shouldn't deter someone from buying a house or not, because they'll typically see the value of their home whenever they buy it. They'll usually see it go up over a period of time, right?
That's correct. And the way I see it is you have to pay rent to live somewhere anyway, so why would it not be yours? And with a mortgage, if you have a fixed rate, your payment's never going to go up. With rent, as we know, as the economy improves, that's going to move up just like everything else with real estate. So now you're going to be in a year later, you're going to pay more. With a mortgage, the only reason your payment will ever go up if you have a fixed rate is because your taxes went up or your homeowner's insurance went up.
I know for home prices, typically I see about a 5% difference from bottom of the market in winter to peak of the market in the summer.
Sure.
I would guess that there's probably not that fluctuation in interest rates that people really shouldn't be that concerned about.
Typically not. You definitely have weeks where good news keeps pouring out, and then you might see some real volatility there. But what I've seen over the last year is that then some bad news will come out, and then you'll see them kind of come back to the mean again. So, they're hovering around, the 4.875 to 5.25 right now. A year ago they were probably 4.5 or under. So that should give some perspective, but it's relatively been quiet since the big jumps.
All right, so the next question that I get a lot, or I see from people, is closing costs. This is actually an idea that I brought up to you when we started dialoguing about doing a video like this. So closing costs, what are they, first of all?
Closing costs are our costs to produce a loan. I mean, we have to pay people to underwrite, process. Appraisers have to get paid. Unfortunately, in a refinance, lots of people get their hands on the pie. You have title company, you have appraisers. You've got to record a deed. You've got the mortgage company who has to pay their employees to produce the loan. There's lots of regulations that we have to go through, paperwork retention, things like that. All that stuff costs money. So generally speaking, with closing costs, across the board, you probably average about $3,000 to $3,500 in hard closing costs. Now, where people get confused is usually there's an escrow account involved. So that's going to likely raise that number quite a bit to probably $5,000 or $6,000, depending on how much tax we have to collect, how much insurance we have to collect, all those other items that have to be paid outside that aren't closing costs, but they do add to what you either bring to the table or have to finance into the loan for a refinance.
How does someone like figure out what those closing costs are going to be? Do they tend to vary depending on the price of the house, or are they usually pretty set and streamlined regardless of what type of house or the purchase price that the house is?
They definitely don't scale tremendously with the price of a house. A $60,000 purchase isn't going to be too much different than a $200,000 purchase. The only thing that's really going to change the cost there is the title insurance. Title insurance goes up incrementally, very small, in how much loan they have to cover. So that's really the only cost, besides prepaid interest, that changes the cost of a loan. So it's relatively flat and doesn't scale as you get more expensive.
Are there ways to reduce what a buyer owes for closing costs? Are there ways that they can sort of mitigate that or manage that a little bit better?
Absolutely, and this can work with a purchase or a refinance. When you do a purchase, you have your down payment, and then you have closing costs that you have to bring to the table, assuming that you're not going to get a seller to pay it. And in this market, that's a little tough. So what you can do to mitigate that is there's something called premium pricing. Let's say the market rate for today is 5%. Well, you could take a 5 1/8 or a 5 1/4, and then the mortgage companies have their margin set, so then they can give you that overage of the margin in the form of reducing what you bring to the table for closing costs. Now you can go the opposite direction too and get an under market rate by paying what's called discount points. Now that will raise your $3,000 or $3,500 cost, but again, a good loan officer is going to go over the cost, benefit, return on investment on that and say, if you take this, the difference in those two payments will net you out at this particular time in the future.
Okay, cool. Super helpful. I can already hear people watching this, some people saying, yep, got it, Sean, super cool, makes sense to me, but maybe a small segment who maybe numbers aren't their specialty and forte. So when in doubt, they can always call and reach out to you if they've got questions or clarifying questions. So how can people get a hold of you if they want to get some more detailed questions answered from you?
Okay. The best way to get a hold of me is usually my cell phone, which is 720-939-8384, or email is always good too, or text that same number I just gave you. Email is S like Sean, BOEHMER @amerifirst.us.
Cool, and I'll also link that up in the video description as well, because you've got a unique last name that sometimes I'm always like, okay, is it B-O-E or B-E-O? When in doubt, use the digital form, copy and paste it into an email, and never fails. So, Sean, thanks so much for meeting up with me. Really appreciate the time and the insight and the expertise in this area, because I know that my specialty is helping people buy and sell houses, but I always rely on you for the lending side, and you've always come through every single time. So thanks for jumping on the video, and hopefully you found it valuable. If you do have any other questions, as I mentioned before, feel free and put them in the comments down below, or you can reach us with the contact information down below in the video description. Thanks so much, and see you in the next video.